Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I am the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. Hey, look, if you're out there and you're working for one of the big investment firms as a wealth advisor, if you're a captive employee, if you're a W-2 employee, and you've always wanted to make the jump to the independent side, we may be a great fit for you. One of the unique things about our group is that we combine the camaraderie that you can find with a firm with the flexibility and freedom and independence of running your own practice. See, the thing about it is a lot of advisors are too afraid to make the jump because of all the logistics of moving from point A to point B. My business partner, Jason Nero, and I have built a very detailed blueprint to help you be as successful as humanly possible when you move to this side so that you can have the autonomy and freedom to make the best decisions for your clientele and also for your practice and your staff. But the other part of being independent is that it can be a lonely experience. You can be on an island all by yourself. And what we've done is we've taken the best of independence and we've also brought in a level of camaraderie with our parent company as you plug into our portal. So if you have any interest in becoming an independent wealth advisor and you need guidance on how to move from point A to point B, we may be a great fit for you. So today I had a great interview, yet another one with Matt Orton. So Matt is the head of advisory solutions and market strategy at Raymond James Investment Management. Matt has a very interesting background. He holds an MBA from Cornell, and he also was a quantitative analyst, a quant per se, at Goldman Sachs. So he brought a lot of great insight into the markets today. I think the biggest thing that I have wrestled with, especially as we've gotten into the second half of the year, is that as I start to see greater and more optimistic opportunities within this market, I still am being bombarded with an amazing amount of negativity from the media, and I'm even hearing a lot of negativity from some of our clientele based on the steady diet of fear that people are receiving. I think what you'll love about this interview is that you're going to hear a much more optimistic tone from Matt today. And it's rooted in data and it's rooted in factual events that are happening right now. And so in the midst of some of the headwinds, there are a lot of tailwinds to the economy over the next 6 months and over the next 12 months. So we can do a lot of different discussions about the Fed. We talk about policy. We talk about Trump and tariffs. We also talk about long-term trends like AI. What does AI mean for the workplace? What does it mean for long-term investment opportunities? So I think from both the short and long term, you will find this to be a very enlightening discussion. I'm super grateful for Matt, who's a super busy guy over at Raymond James Investment Management. It was just great to have him on the podcast to pick his brain. And not only does he have an economist mind, but he has a market mind as well. So it was fun for the two of us to really hash out some ideas today. So I hope you enjoy. Hey, Matt, thanks for coming on the podcast today.
Absolutely. It's great to join, Drew.
So let's dig right in, my friend. We were talking before we hit record about the markets. It's been an unusual year, to say the least, in terms of sort of the political moment. And at the start of the year, you know, I there was actually a particular day that I was at home in bed, not feeling well, and I was watching the markets, and minor news would come out of the White House, which would lead to major market shocks, right? I remember when there was the 90-day pause that was put on the tariffs and the stock market. I think the NASDAQ, this was the day I was actually sick in bed, the NASDAQ within about less than 60 seconds went up about 10%. And it's a type of volatility, both up and down this year, that I'm not even used to, even though I've been doing this job for over a decade. This has been a different type of volatility. And so what would you say is at the core, what was at the core of the volatility in the first half of the year? And then the markets have really rebounded and are a lot more stable. What would you say has shifted in terms of the market landscape as we're getting into the second half of the year?
Yeah, I think this is a great way to start the conversation because I think everything that we have experienced this year, and really even since the election that we had in November, comes down to this idea of uncertainty. And when you look at really the primary driver of the massive market crash after Liberation Day on April 3rd, the big moves you had up and down following that, it was all predicated on the fact that investors really didn't know how to judge the future, what the world was going to look like based on something that we haven't seen in the past 100 years. So we haven't seen what was being talked about, at least from an economic perspective, really in anyone's lifetime who's currently in the industry. And so that level of uncertainty really permeated the market for a while. And then it was also April 2nd, right after quarter end. So we were literally going from all of that uncertainty into what should have been and what was a great quarter for earnings, but where company management teams had absolutely no clue what was going to happen in the future because of the uncertainty with policy. So we've gone through this phase of recalibration over the past number of months. And so you're seeing that level of uncertainty significantly decline. And along with that, you're starting to see the level of volatility in the market also come down as a result. So, markets hate uncertainty. We hear that all the time, but I think it literally was emblematic of what happened in April that really drove all of those massive swings that we experienced.
What about the White House, or what about the situation is more certain? Because in some senses, I look at it and say, well, we don't really know exactly where tariffs are going to go. The deadline's getting extended. It might get extended again. There was an agreement with Japan apparently last night. Do you think there is greater certainty in the marketplace, or is there maybe a numbness in a sense to the tweets that are coming out, et cetera? What do you think is more certain about the environment, Matt?
Yeah, I like the word numbness because I think that there's certainly an element of that. But I think the big driver is that we do have increased certainty. While we don't know what ultimately is going to happen with respect to tariffs or where the actual effective tariff rate is going to be, I think we can be fairly certain that the worst left tail scenarios that were being priced into the market on April 3rd have been removed. I think the administration and everyone negotiating for it has shown they ultimately want to make deals. They're not here to just impose tariffs that are going to drive the economy into a recession. And so they've walked back from some of their worst inclinations that I think people were really worried about being implemented earlier in April. So I think there is certainty in that. While we don't know where the outcome's ultimately going to be, you've gone from July 7th to August 1st. Who knows if August 1st gets pushed back based on where negotiations sit. But we do know we're making progress, and I think it's the idea of striving for marginal progress and actually seeing some trade deal signed, knowing there's late-stage negotiations with a number of countries taking place right now. I think that gives the market the ability to write off a little bit of the bluster. There are still risks involved, but I think the worst risks are no longer there.
Yeah, it felt like at the beginning of the year, and particularly if you listen to people like Peter Navarro, who'd be sort of the main sort of trade ambassador within the White House, it felt like we're going to go back to sort of 1920s industrialization within the United States. We're going to bring all the manufacturing plants back. We're going to have Nike shoe factories again. And I think there was some fear that that type of experiment was going to be pushed. And at least that's my theory on why the markets were so volatile at the beginning of the year. But then as the year has evolved, it feels a little bit more like the Trump art of the deal. Like he came in high and he's trying to negotiate down. Do you think that's a little bit of what's happening? That he is the art of the deal president, but I've heard different camps on this of like where they're coming from. I know we don't know the psychology of the man and I don't have any connections to the White House, but do you have any sort of insight into do you think this is maybe a negotiation tactic from the beginning, and do you think the markets are digesting it as such?
It's a great question. I have no idea if from the beginning there was this grand plan of this is exactly what they wanted to do. They might say it is if things work out really, really well, but there's probably some element of that in there, where we know we're going to start with a ridiculously high level, see what we can get away with, and then see where there might be deals to be made. Either way, I think there's a couple of things at play. And again, I wish I had closer connections in the White House to better appreciate the inner workings of what's going on. But I do think there's an element of legacy that Trump is concerned with, because he talks a lot about doing a lot of the biggest things, like the One Big Beautiful Bill Act being the largest kind of package that we've ever had with respect to fiscal stimulus in the country. So there's a lot of things I think he wants to live forever in doing, and sending the country into a recession because of policies you imposed is not something I think that he wants his legacy to be based around. But reordering the global trade system, it's even a tiny bit in some way, shape, or form that still keeps our economy going, I do think is something that would be palatable to him for being memorialized in the history book. So I think there's a large piece of that is at play, which is also why, even though some of the fiscal and trade hawks like a Peter Navarro might still want to push for a more significant global reordering, I think Trump and the practicality that comes behind his business experience probably also says, I don't know if I'm going to get what I ultimately want out of this either. So I think there's a lot of that at play, which again goes back to this notion that the worst, risk scenarios that we were very, very worried about in April, you can have increased confidence that those likely aren't going to come back. So even if Trump feels emboldened because the economy is doing well, the hard data has held up, earnings have come in well, management teams are bringing back guidance, he might feel emboldened come August 1st to implement some of these tariffs. I'd still be inclined to say it's probably more of the art of the deal, like you said, Drew, a negotiating tactic towards getting more deals signed, because there's some key deals. Japan, I think, was one of them. Now that they've agreed to buy rice from us, where we're going to have a trade deal with Japan. But there's probably small things like that. And if we can get through those little hiccups, I think you can see something maybe with the EU, something with Canada, Mexico. And if you can achieve all of that, I mean, those are our biggest trading partners, we're going to be okay.
I couldn't agree more with you, and I really appreciate just the objective, optimistic position, because so much when I hear from clients, what they're getting fed is really a steady diet of intense negativity, that this market is sort of poised for a big collapse, and I really don't see it that way. Now, this is speculative on my end, but I view the current White House, particularly the president, as not being an overly ideological man. I think from a policy standpoint, some presidents come in ideologically within some sort of framework or rubric that they're pulling from, whether it's an economic camp that they subscribe to or an overall sort of political philosophy that they subscribe to. He's kind of not your typical president over the last, and I'm not just talking about the rhetoric, I'm talking about like the policy stances. And I view him as someone that is subject to change. And I think he assesses the policies and he puts his finger in the air. And if it feels like, man, this is he just strikes me as really pragmatic. And if he feels like this market is not going very well, then I'm gonna adjust my policy stance. In fact, there was an article, and I've mentioned this a few times on this podcast, I'll mention it again. There was some reporting coming out of the Wall Street Journal that he had flown down, that Scott Besson, the Treasury Secretary, had flown down to Mar-a-Lago to meet with the president. And I view Besson as a relatively pragmatic, old school banker. And his questions, I believe, based on the dynamic of the article, was that, hey, like, how willing are you to initiate a recession? And the president had responded back to the Treasury Secretary Besson that he was worried of a depression. And that, like, look, I'm reading between the lines a tad here, but that struck me as someone who's quite pragmatic, that he recognizes that maybe he's either going too far with his policy or it was the art of the deal the whole time. And just even reading some of those dynamics in those articles has made me feel a lot more confident about the back half of this year, and that tariffs probably won't go too far. What is your take on that? Like, any feedback on him being a more pragmatic policymaker than maybe prior presidents?
Yeah, I think he's definitely a pragmatic person. At the end of the day, that's his background in business training, is trying to make deals. As a New York real estate person, I mean, he was going to take whatever the best possible deal is. And I think I agree with you, Drew, that like, I don't think he has too many preconceived ideological notions that he subscribes to. And I think we saw that play out during his first term. He might have certain things that don't necessarily need to fit with the job with respect to past slights or things like that you come into the office with. But with respect to policy itself, a Republican passing a massive stimulus bill in the face of fiscal deficit hawks as part of your camp, but still wanting to push it like that, if anything, speaks to not having those ideological conceptions of what he wants, except we know he wants a good economy. I think at the end of the day, he wants a good economy. He wants to win. So anything that can help feed that notion of taking wins, whether small or large, and making sure that the economy is able to grow and the market continues to move higher, I think all of that fits with just, the type of person we think is in the White House. So my assumption is that pragmatism is going to continue in some way, shape, or form. And I want to go back to what you said at the start of the question, Drew, which was just about the very, very high level of pessimism that I think investors have because news is naturally negative, especially around just things that are uncertain. We tend to react negatively to things that are uncertain to us. I certainly did at the very onset of Liberation Day.
Me too.
But what I like as an investor is I like to see pessimism in the face of fundamentals and data that actually continue to hold up. So I remained fairly positive despite my own personal pessimism and questions around some of the stuff that was happening. Because when I talk to management teams, when I talk to CEOs about what is actually happening on the ground at your companies, how high is the uncertainty actually there? It's there, but they're still managing their businesses. People are still buying things. Money is still being spent in the economy. Critically, there are still jobs. So it was hard for me to become too negative, especially because everyone else was negative, which generally is a signal to me that there's a lot of room for the market to continue to climb that proverbial wall of worry that I think is really, really important.
I think that's an incredibly important call out, and I felt the same way at the beginning of Liberation Day. Sort of secretly, I was a little bit panicked and frustrated, and then but I think with clients, and I knew sort of deep down in my sort of more logical side of my brain, I knew that I think this is still going to pan out okay, which is why I didn't go into massive hedging positions, generally speaking, within client portfolios, because I felt like the evidence wasn't strong enough that we were on the verge of some big recession. I just didn't see it. With that said, there's a difference between the hard data and the soft data, right? Like the hard data seems relatively optimistic, but then the soft data, like consumer sentiment surveys, they still seem pretty dour. What's the mismatch there in your opinion? And do you see the negative soft sentiment with relatively strong hard data?
Yeah, it's interesting. I think a lot of investors were coming out, especially I call during peak uncertainty with respect to tariffs. Everyone was saying, or many people were saying, that the hard data was going to have to catch down to the soft data, that you necessarily were going to have a recession or significantly slower growth as a result of the tariffs that were being put in place. And we haven't seen that play out. And I never subscribe to that idea that the soft data or the hard data has to catch down to soft, because again, people always overreact. We saw this during COVID. I think COVID was the best analog that we can take with respect to sentiment, both at an individual consumer level and at a corporate level, with respect to how that doesn't necessarily translate into reality, because there's a massive shock that might be internalized very different from people. The environment itself is just much more highly politicized today than it has been in the past, and that level of politics, I think, permeates into sentiment data in ways that we haven't seen or appreciated in the past. Actually, University of Michigan has started segregating some of its consumer sentiment data by political party, and it is fascinating to see the massive divide that has happened, particularly post-election, with respect to how Democrats or Republicans perceive the economy and inflation expectations. I mean, just massive polar opposite divergences. So, people are looking at things through a very different lens, and then you feel how the economy is happening very, very differently, even if in actuality things are still holding up well. And to me, the most important thing that I look at and really was focused on during this peak tariff uncertainty was what's happening in the jobs market. Not only are big corporations changing their plans or cutting job openings, which largely didn't happen, are small businesses starting to make that change, because small businesses at the end of the day are the biggest employers across our overall economy. Mm-hmm. And we haven't really seen that happen. And small businesses who theoretically will be the most impacted by wherever all of these tariffs settle, you're still not seeing significant layoffs or even reductions with respect to employment at the smaller business level right now. So when I put that all together, it says people still have jobs, and people with jobs in this country will still spend money in some way, shape, or form. The fun of my job is getting to try and find the areas of where they're going to be spending that money. But for the economy as a whole, it doesn't matter where or who's spending, as long as in aggregate, people are still spending or increasing that level of spending. So, there's so many different nuances, but, that's what makes this really interesting and fun.
Yeah, and my understanding on the employment side of thing, not unemployment data, but employment data is, and correct me if I'm wrong, is that it is a leading economic indicator. Is that true, or is it more of a current indicator?
It's both. I kind of put it in the middle of it's leading, but it gives you a more current state of affairs too, especially when you look at, I think, like the ratio of job openings to unemployment. That can be more of a leading indicator on a 1 to 3 month basis of where things might be going. But overall, it's certainly not a lagging indicator, which is why I appreciate it and really follow it real time every week, looking at continuing claims, job openings, because that gives you a more real time future sense of where the jobs market actually is.
So this is sort of a dumb question, but it's on my list here. Still a lot of talk about recession. It sounds like you're not calling for a recession.
No.
Yeah. So talk a little bit about that, and where do the markets head from here?
So recession, in order to have a recession, and I'm going to go back to 2022 as well, because 2022 was another year where everyone was saying we're going to have a recession because of the interest rate hikes. I wasn't in the recession camp. It probably sounds like I'm a permeable with a lot of this stuff, but it all came back again to the jobs market and how people were spending money in the economy. What didn't happen in 2022 was we didn't have pervasive slowdown across the overall economy that was prolonged in any way, shape, or form. And in order to have a recession, it's got to be pervasive, it's got to be prolonged, and it's got to be pronounced through a lot of areas of the jobs market. And we had none of those three things. If anything, you may have had one out of the three at different times. And so you ended up with these rolling recessions. You had different sectors or industries going through different periods of contraction based on their sensitivity to the interest rate cycle. We also had this bizarre feeder effect from COVID and basically zero interest rate policy where people were locked into their mortgages. So your general feedback mechanism around interest rate hikes tends to go through the housing market. That hasn't happened. That's still not happening today because so many people have such low interest rate mortgages.
They're not
so
refinancing.
There's all of these weird distortions that have all kind of fed together. And, I would say, both of us who have more traditional economic backgrounds, I've basically thrown the economic playbook out the window. I let it inform some of the questions that I ask. But really, ever since COVID, traditional economics hasn't worked as the gospel with respect to how economics will translate into the overall market. And so having more flexibility and looking at more real-time data and actually seeing what is happening to the consumer becomes the most important thing, because we are 70% driven consumption economy. And so to me, it's, are people making money, and are they spending money in this economy? And do they have the propensity to continue to consume going forward? And right now, I think every box is still checked yes. There's still more job openings than unemployed. You're not seeing continuing claims, which are the number of people that are sitting on the sidelines after getting laid off. You're not seeing that number tick up. It's been very, very stable despite the uncertainty with respect to tariffs. And I think critically, a lot of people have been making their wage growth has exceeded the average rate of inflation for about the past 18 months or so by a meaningful degree at the bottom of the economy as well. So that marginal ability to consume because of that wage growth, I think has increased much more than a lot of people have appreciated. And I'll just throw in an anecdote on that, and this goes again back to COVID. My wife is a veterinarian. And so one of the practices that she has, we basically were paying $15 an hour average wage, which was well above minimum wage in Florida at the time. And then once COVID happened, we were forced to increase the minimum wage to $18 an hour that we were paying some of the technicians and support staff. And then we had to increase it to $20 an hour, and then to $22 an hour, and then to $24 an hour. And when we got to 28, I told my wife, I said, these numbers don't work. Like you can't make this business work if you continue to do that. And we lost people still because there were other places still paying more. But when I think about the impact to those individuals going from $15 an hour to $28+ an hour, that's an 80+% increase to your bottom line and take home pay. That gets spent in the economy. And so I think we really underappreciated how widely that was happening and how those rates are now level set at those base levels going forward. And so there is a much better ability for people to consume even in the bottom 50% of earners. Doesn't mean they're not stretched. But I think we've underappreciated how important that has been to sustaining consumption. And then the folks at the top who are more levered to equity markets and their house, their ability to consume has continued to increase by multiples of that. So the consumer in aggregate, I would argue, is still very, very healthy. And when I look at what management teams are even guiding during this earnings season, listen to United or Delta Airlines, the premium segment of their business is rocking. Those consumers continue to spend and travel. And so that to me is a good indicator of where things can still go, at least in the next 6+ months.
One of the things that's come up, these are all fantastic points, by the way, and one of the other things that has come up, and I have a critique of this, but I'm curious on how you'd respond to this, is they'll say, well, yeah, that's great, Matt, and there's all these good signs, but did you know that household debt's at an all-time high and corporate debt's really high? What do you say to people that point out that we have maybe debt problems or household issues there, and it feels like this could lead to something that could be more of a significant event in the future?
Yeah, I would say, and again, this goes back to aggregates versus specific cohorts. I would say the household balance sheet is still very, very clean. When you look at the household balance sheet today compared to where we were in 2006 and 2007, we are far better off. And there's plenty of charts I can share that show that. So we went through this massive deleveraging period, probably from 2009 to 2013, and households and corporations got their acts in order. And post-COVID, you had some of the zombie energy companies and those that were over-leveraged also were taken to the woodshed, forced to get their balance sheets in order. And so what you have today is while certain cohorts of the consumer do have increasing leverage problems. You look at credit card debt, you look at certain delinquency ratios that are coming up. They are ticking up, but I would say it's not an aggregate and not in the places of the consumer who actually matter most to the ability to sustain spending in the overall economy. And corporate America remains incredibly healthy. Corporate balance sheets are clean. Apple made $0 of interest payments last year. I mean, just think about that. And so
that's wild.
Yeah, it's nuts. And so you look at how clean, like interest coverage ratios, your ability to pay your interest versus your debt is at some of the best levels we have seen in decades across corporate America and even in smaller companies. People love to hate on smaller companies as being indebted, have problems because of higher interest rates. And that's true across certain pockets. But the free cash flow generation and the ability to cover their balance sheet obligations has not been better in many cases, even across smaller companies. So the health of corporate America is there to make investments, and you're seeing that play out in CapEx. And that's one of the reasons why this AI spend that we have going on, that largely saved the economy in 2022, when other spending was down. And that investment going forward hits so many sectors and industries. And that's likely to continue going forward because companies can afford it.
You know, one of the other things I point out to people when it comes to the debt, because I get the like, oh, household debt's at an all-time high. Usually that's a pundit's pointing out nominal numbers. Yeah, sure. The dollar value that you would ascribe to it may be at all-time highs, but debt as a percent of, say, overall wealth or debt payments as a percentage of income, based on the data that I've looked at, the hard data I've looked at, is actually quite healthy. The other thing I've noticed, and you alluded to this, is that if you look at those demographics or those people that actually have lower debt ratios, it's the wealthier individuals in society where you would see most of the consumption actually occurring. And so there's just the nuance to the data that a typical pundit on CNBC or on Fox Business is going to ignore, because it's that fear narrative just sells so well when it comes to the household debt. But when you actually look at it through a more honest or critical eye, everything you said is what I'm hearing from other thoughtful people. So I really, really appreciate you pointing that out. So let's get into Fed policy, because I wonder if the Fed is going to shift here. There's a lot of pressure from the White House to lower rates. Right. So so first of all, I have two questions. I'll start with the first one. Do you think the Fed is going to cut rates this year? I'm not going to hold you to it because no one has a crystal ball, but what is your gut instinct for the back half of the year? Some are saying 2 quarter-point cuts. I'm actually in the camp that I would not be surprised if we wait until 2026 if the Fed chair waits till 26 to actually cut rates. But what do you think the Fed does, and what do you think the Fed should do?
Yeah, those are two great, separate and distinct questions in terms of what I think can happen, or maybe what can happen versus what should happen. And then I would also add the final question of, does it even really matter at the end of the day to being able to sustain the economic growth that we have? And so I'm with you, Drew. I've came into this year in the camp of 1 to 2 cuts. I'm still in the camp of we're probably going to see 1 to 2 cuts, definitely September or post. I think the Fed's guided to that. We've got the FOMC coming up, so we'll get a little bit more. And Powell loves to use Jackson Hole next month is kind of a surprise. We're setting the market straight with respect to policy. So, maybe something could come up then, but there's no reason to. So can the Fed cut rates? I mean, it could. Inflation has been coming down. Inflation data has been fairly well behaved. But should the Fed cut rates? I would argue not right now, because we still haven't seen the full read through with respect to tariffs. And again, going back to our earlier discussion, I don't think the final read through is going to be as bad as a lot of people were speculating back in early April, because, we're negotiating everything down. But we've been drawing down inventories. There's been a lot of, I'll call it, kicking the can down the road with respect to the inflationary impact of tariffs. So there's still going to be something that happens. We're getting a little bit here and there when you get the CPI prints or PPI prints, or looking at kind of what producers are paying for some of their inventories. So it'll be interesting to see how that comes in. And so should the Fed cut rates? Probably not, because they don't know if that downward trajectory we've been experiencing is going to be sustainable to the degree they would need to feel good about bringing rates down, which feeds into the last question, does it even really matter? I would say it doesn't. Whether they cut rates by 25 basis points, next week, or if they do nothing this entire year, I don't think the economy needs it because, again, corporate balance sheets are very healthy. There isn't a significant, capital's already flowing very, very well right now, where we're seeing increases in acquisitions. We're seeing IPOs come back to the market. So the capital markets themselves are very, very healthy. And so the impact of that quarter point rate, while it might help marginally with respect to mortgage rates, doesn't make that much of a difference. And when we did the jumbo 50 basis point cut in September, rates actually went up 50 plus, I think almost 100 basis points as a result because of concerns of fiscal spending. So again, cutting the rate or the Fed funds rate doesn't necessarily dictate what's going to happen at the back end of the curve either. So there's a lot of nuance that goes into the rates that ultimately feed into the overall economy, but I would argue it's not needed at this point.
Couldn't agree more. In one sense, I think there's a strong argument that they should just go ahead and wait till 2026. And I understand why sometimes Republicans or the president maybe want to cut rates. I mean, every president is going to apply some level of political pressure on the Fed to reduce rates. I get it. I think that's pretty typical. But at the same time, if I'm the Federal Reserve Chair with the economic backdrop that you just laid out very articulately, it doesn't seem like there's really a strong case for it. And inflation has come down, but hasn't totally burned off either. And I still believe, based on several reports and other economists that I've interviewed, that there's still quite a bit of money sloshing through the economy from the stimulus that we experienced back in 2020 through 2022, particularly 2020 and 2021. Not all of that money has actually worked through the economy. And I think people do forget that it does take time and there's significant lags when the Fed engages in massive monetary stimulus for it to fully work through the system. And so I think there's a strong argument for the Fed to hold off, and I couldn't agree more. I don't think it matters. Like, if we cut rates by 0.25%, is it really even going to change the dynamic of the economy? That is such a small rate cut. And don't they want to keep a few bullets in the chamber if we actually were to go through a recession? Because the zero rate policy has been problematic for the Fed. And I'm kind of going back to the books when I took a monetary theory seminar in grad school, that like, hey, you need to have, oops, I lost my audio. Can you hear me, Matt?
Oh, yeah, I can hear you.
Okay, sorry. I'll just edit this part out. I think the Fed needs to retain some type of bullets in the chamber if we were to go to a zero rate, if we were to go into recession so that we can actually cut rates, because that was becoming problematic for them, that they couldn't provide any sort of monetary stimulus when we're at a zero rate policy. The other thing that I like to remind people about, and this is something that my monetary theory professor said in grad school, is that the Fed does not control interest rates. The markets run interest rates. The Fed just happens to be the largest influencer of interest rates. And so, to your point, even in the face of Fed decreases last year on the interest rate environment, we still saw things like the 10-year Treasury yield go up, right? So it doesn't mean that they can even pull it all off. And do you agree with that statement?
Absolutely. Yeah. The Fed has influence on the very front end of the curve, which is basically overnight lending.
Right.
The back end of the curve, 5, 10, 30 years, those are the rates that actually really ultimately flow into the economy outside of just some capital market stuff. That's what ultimately matters. And the Fed does not have control over the back end. Powell's been pretty explicit in reminding everybody of that too, and that what we do doesn't necessarily translate into the back end. And in fact, policy does have much more of an impact in terms of what happens to longer dated rates that then flow more into the overall economy that we experience.
To what extent are tariffs influencing Fed policy right now as well? Do you think that is playing a role in maybe Chairman Powell saying, you know what, let's wait before we do rate cuts until we understand the inflationary impact of tariffs? Do you think that's playing a pretty significant role?
Yeah, I think it is. And it comes back to that idea of uncertainty, Drew, that we talked about at the start of this, which is that in the face of uncertainty with respect to how tariffs could ultimately flow into the inflationary picture, absent of needing to keep the economy going, like the Fed's very lucky that we're in a position where growth is still good. The economy is still expanding. It might be slowing that level of expansion, but I would argue that was going to happen even if we didn't have tariffs, just because we've been growing at such a high above trend rate for such a long time. The direction was naturally to slow down, but we're in a good place. So the Fed doesn't have to cut rates to keep that growth going. So why take the risk, especially now that you have potential inflationary impacts and also fiscal stimulus coming into the economy? Why not see how that plays out? Because the last thing he wants to do, after having already cut interest rates by 100 basis points, I mean, we forget the Fed has already cut interest rates fairly meaningfully from the highest levels that we were at. Why take the risk to cut more if it's not needed, and end up in a potential Volcker situation where, next you're going to have an overheated economy, big inflationary pressures? Not saying that's going to happen, but wait 3 months.
And by the way, I think that's why the markets panicked in 2022, is because we all went back to the early 80s with Paul Volcker. I think what was different about that environment, though, is that it was pretty stagflationary to begin with, and Volcker just basically felt the need that let's just rip the Band-Aid off and let's contain inflation. The Phillips curve, the idea that inflation and unemployment were inverse relationships, was thrown out the window. They were both high. We had inflation and unemployment. And so that was a different time with a different policy response that led to a recession in the early 80s. And I appreciate just going back in the conversation that in 2022, we didn't come in with that type of a backdrop. And I think you're right. I think we just kind of had to throw the entire economic playbook out the window. One other question, and then I want to transition to long-term trends. When it comes to tariffs, some people believe it's going to lead to sort of consistent inflationary problems. I'm very open to pushback, and if I'm wrong, I will agree. I will point it out. But one of my takes is that even with all the tariff activity that's occurring, I view that, based on research that I've read, as only providing a one-time increase in inflation on certain goods. I'm skeptical that tariffs will actually lead to full-scale, across-the-board inflationary pressure on all goods and services in the economy. So I don't view tariffs, even so much in the short term and especially in the long run, as becoming a long-term inflationary problem for the United States economy. Open to critique, though. What is your take on that?
I mean, I agree. And I think what you brought up, really what inflation is. I mean, inflation is a year over year, generally that's how we look at it, a year over year change, an increase in prices. And so if prices increase one time because of tariffs, in order for that to sustain, that means you're going to have to keep increasing prices by that degree year over year over year. That is highly unlikely. I think once tariffs come in, it's a one-time thing. And just because the way of that math works, your inflation will decelerate as a result, because those price increases should become meaningfully less, or even potentially deflationary if we reduce the overall tariff rate. So I think that's an important piece to look at with respect to inflation. The full impact on the overall economy, I just think it's too soon to tell what that actually is.
Agreed.
And if there's anything we've seen from corporate America, is that companies are very, very good at having a plan A, B, C, D with respect to where they're sourcing materials, how they're dealing with input costs, how they might move things around from countries that might have higher tariff levels to slightly lower tariff levels versus manufacturing it in the US. They're going to optimize. They have armies of people to help them make those informed decisions with respect to how they can preserve the quality of their product while optimizing their input costs. And so I have no doubt that is happening in most boardrooms of publicly traded companies today. And they're going to come out of this as well as they can once we know exactly how things will settle. So I think the best thing that we can do is wrap up a lot of these negotiations in the nearer future, sooner rather than later, so that companies can go back to managing their bottom line instead of having to figure out where their optimal mix of business exports and where things are moving, where that's going to be. So that level of uncertainty, again, it's still there. It's just meaningfully reduced. And hopefully we can get rid of most of that, call it 95% of that uncertainty by the end of this year. That would, I think, would be the ideal read-through to minimize the long-term inflationary impact.
Let's talk about long-term trends. Obviously, everyone's talking about artificial intelligence. I know that within my practice, we're using an AI tool for note-taking. It's unbelievable in terms of time saved for my practice. I mean, extraordinary. I probably spend over 100 hours, if not more, a year just in documentation because it's important. We need to keep records of everything. The regulators want to see that. And so I see some of these small implementations that are happening with AI that are making dramatic changes for me within old school wealth management. I can only imagine the level of advancement that's occurring in terms of productivity in other sectors. Let's talk long-term trends. Like, where is AI going? What do you think it means for us in the next maybe 12 months? And then what's kind of the longer-term outlook on how AI might change the economy?
Yeah, I love that we're starting with AI because I do think like this is a true catalyst. It already has been. Like I mentioned, it's saved a lot of the economy in 2022 from an investment perspective. And you look even in 2025, this year, we're hyperscalers. So 6 companies are going to spend about $325 billion just
Unreal.
this year on AI infrastructure investments across a number of different parts of this economy. So it is very real. The way I look at it is similar to what you were saying, Drew. At this point, artificial intelligence, at least as it's being integrated into the workforce, I think of it as giving us almost an exoskeleton. It makes us as workers stronger and better. The tools that it has, time saving, letting us spend more of our time on value add as opposed to things like note taking. Again, my wife in a veterinary practice uses simple AI in terms of dictation software. Again, taking notes, putting it into the system, reminding her of things where she said, prescriptions need to be filled. You're able to see 3, 4 plus more patients on a daily basis as a result of that and minimize risk. So it's very real to a lot of parts of this overall economy. I mean, I use it for presentation help. You can throw it into, throw a presentation in and say, give me 10 questions someone in the seat might push back on with respect to the ideas. And it does a great job of it. So it makes us better. Is it going to replace jobs down the road? Absolutely. But the workforce itself continues to evolve and change. And we've been through many fits and starts of that over the past 100 years that have looked different. The Industrial Revolution, post-World War II, massive changes in the economy. So I think we continue to move to a more value-add driven economy, which at the end of the day is where you want to be. That's why the U.S. has been so successful, because a lot of our GDP is produced in value-add services, not so much just production of stuff, which AI can really help replace and automate through robotics. So I think there's a massive tail to this investment. And the way I look at AI is almost in a pyramid, right? So at the base of that pyramid, you have the infrastructure layer. And within that infrastructure, we're talking about things like the semiconductors, the chips that still can be improved. There's still so much data that we do not process and utilize today. So building out that infrastructure that includes data centers, a lot of where this CapEx is going to. And eventually, as you move up that pyramid, you're going to be moving towards that application-based software. So it's using the platforms, which kind of sits in the middle of the pyramid. That's your OpenAI, your Perplexities, your Claudes, all of that is providing the system and the platform upon which the applications that our companies and other companies are going to use and build within those frameworks can actually be deployed and have a real impact very specifically in certain industries and parts of this overall economy. And we're still a far, far way away from getting very, very refined models there. So there's still a ton of investment that has to be made. It's going to be a lot of learning along the way, regulation probably that comes into the picture. So there's a long, I'll say, right-hand tail to this part of the investing equation. And despite the eye-popping gains we've seen across a number of companies, I do think those can continue, but it's going to translate. It's going to change to the next levels of that pyramid as we move further and further into this cycle of AI build out.
I had a friend the other day say, AI is not coming for your job, but someone that's using AI is coming for your job. What do you think of that?
That's well said. It's absolutely true.
Yeah, I thought that was spot on because I know in my industry, in our industry, we're starting to see some of those first level adjustments. I think particularly with like helping us craft emails or maybe prep for a podcast interview, for instance, or things like note taking. It's sort of the first stage of implementation where I do think it to your point, gives you that extra exoskeleton, and I'm seeing the benefits, and I can only imagine where this is going. So it's pretty darn exciting. There's been a lot of chatter, though, about significant job losses, but I'm with you. If you look at like the Industrial Revolution and the automobile, yes, buggy makers lost their jobs, but a whole new industry was created, right, with lots of new jobs. And I do think we're going to go through a similar situation. The economist Schumpeter called it creative destruction. He thought it led to recessions. I don't think it necessarily leads to recessions, but there will be adjustment periods within the economy as we transfer labor towards different types of work. But in every major leap in terms of technological advancement throughout history, it has actually led to more jobs and not less jobs. And maybe I'm naive. I just don't see AI as being that different in terms of a jump. And I don't think it's taking jobs away. I really do think it's going to create a whole new set of jobs, but a lot of menial tasks that we no longer need to do, we won't have to do anymore, like note taking. Any feedback on that?
Yeah, no, I fully agree with that. I think the nature and the economy and the jobs market is always evolving. I think that's the key thing. And in the past, the shocks that we've had, like the automobile, like you mentioned, or Industrial Revolution, like those were significant changes to just the overall economy as well. AI is not changing the construct of the economy. We're already largely a services-based economy. So I think that staves off that sort of recessionary scenario again, because how are you going to have a prolonged, pervasive pullback on something that's driving increased productivity to value-add workers across all parts of the overall economy? And there's a lot of things where, at least in the near term, even if AI was going to come for your job, there's still a massive transition period of things where we're still adding value in areas where people want to deal with other people directly. So I think that mitigates and offsets the potential recessionary impact of AI or significant changes to the jobs market in a rapid fashion. I think AI is going to be an evolution probably over the next 5 to 10 years, and then we'll have a sense of really where we're going to be going for this, because there's still a lot of investments that need to be made, and things will change. Even software engineers, we don't need as many computer programmers anymore because AI can do a lot of basic computer programming, but we still need super programmers to program the AI. And a lot of those, I'll call it, decent programmers that don't make the cut, they're still going to be needed to help integrate AI into systems at other companies. So where they work might change, but they're still going to have a job, at least for the foreseeable future, based on how all of this is being rolled out.
So they don't need to start a farm and start growing their own food, is what you're saying?
Yeah, exactly.
Let's continue to talk about trends here. And actually, before I get to another trend, and I'm not asking for stock picks because we don't do this on this podcast, and I know you don't either, but how should investors be taking advantage of this AI boom?
What I love about the AI theme is that it's so much broader than I think a lot of investors fully appreciate, because it goes so much deeper than just, your semiconductor manufacturers. There's ways to invest in AI through energy. And, AI uses a tremendous amount of power. Today in the US, the number of data centers that we have consume more power in a year than the entire country of the United Kingdom. So as we build more and more data centers, because we have nowhere near enough in order to fully realize the ability of AI to have a positive impact on our economy, we need a lot more power to do all of that. So you have a woefully inadequate grid across the entire country and really across most parts of the world. The average age of cable in the US is 25 years old. I think it's 35 to 40 years old in Europe. And you have 3 different grids in the US that don't communicate with one another. So there's massive opportunities for investments and really simple basic stuff. And also how power is going to be delivered differently going forward. You're seeing big gains in nuclear power companies because it's an efficient way to deliver power. So that's an AI play. Site construction for data centers. So companies that make equipment and machinery, clearing sites for data centers and bringing in the water and the electric. That's an AI play. So there's so many different ways that you can invest in this AI cycle that doesn't involve owning something in information technology. So to me, I think the most exciting part of AI is the ability to have very broad exposure to really all sectors of the overall economy, but still have this long-term durable growth theme that's generating earnings growth and better margins for companies in your overall portfolio. So it helps us diversify and have more clear visibility into where earnings are going to go in the future. And I think that's a very good thing for investors.
Yeah, because I think some people look at it and they're like, well, the major chip producers, their valuations are already high and there's already been a 10x run for some of these companies. Like, where are the opportunities still? And you're pointing out that it may not be the most obvious ones. It might be something like investing in a nuclear power company. I think it's a really important call, and I appreciate you saying that. And it's also helpful for us as advisors that we can build a diversified multi-sector portfolio but still take advantage of what is obviously an extremely important trend for the long run. Can we touch about energy for just a minute? Because this has been something I've been thinking a lot about. Is there's been a real push for clean energy, but with respect, it feels, based on the research that I've read, that wind and solar doesn't provide base load. It's not a consistent energy source because obviously the sun isn't always shining and the wind's not always blowing. And there's maybe a move away to some extent from some fossil fuels. I feel like nuclear checks a lot of boxes. It's efficient. It's actually very safe. It's relatively low cost, and it's carbon neutral. So you've got the capitalists on one end who want cheap, abundant energy, and then you've got environmentalists on the other end that really want to be conscientious about pollution and climate change, et cetera. It feels like the perfect marriage. I'm seeing trends in Europe, for instance, where they're starting to push for nuclear, and some of those countries are wanting to fire back up their nuclear plants that they had at one point decommissioned. But there's still some resistance in the United States. What is your thought on the European market when it comes to nuclear? What's your thought on the U.S. market, which has always been averse to it? And do you agree, is the world moving towards nuclear because we obviously need more power?
So I'll answer the last question first. The answer is yes. Nuclear is the way forward. It's the only way you're going to get enough power to realize what artificial intelligence can be and just the growth in humanity across the rest of the world. That is the only way. I think the challenge we have, particularly in the U.S., is I'll call them the NIMBYs, the not in my backyard people. So, everyone wants a nuclear power plant, but they don't want it anywhere near close to them because they still think of 3 Mile Island, right. Chernobyl, which are just antiquated analogs to what nuclear power is. And the challenge is overcoming that. It's where do you build these? Where do you get the right permits? And the challenge is, again, you can't just build a nuclear plant and connect it to the grid. There's a lot of different pieces that all have to fit together with respect to the plant, operating the construct of the owner and operators of the local power lines. So there are big investments that have to be made across the entire, I'll call it, grid spectrum in the country in order to really get the most out of nuclear power. So there has to be public-private partnerships in order to build all of these. And so I think number one, small modular reactors, SMRs for nuclear power are very, very different from what we know nuclear power to be, which were all of the meltdowns that I think keep people a little bit more wary to it. They are incredibly safe, like you said, and they are much easier and less expensive to construct than some of the big projects. I think we recently built a much larger nuclear power plant in Georgia. It's the only recent one that's been built. I'll call it in modern times, so post 2000 really in the US. Billions of dollars over budget, years and years longer than it was supposed to take to build. Those are boondoggles. So you have to go the direction of these smaller reactors. And again, all of that's going to come from the willingness to permit and build them and the willingness to invest in the grid. But I know people are looking at it. I was lucky enough to have lunch in Washington, D.C. a couple months back with some senators and former senators, especially from Sun Belt states where there are massive data center projects being built. And their estimation is that they're going to need between $1.5 to $3 trillion over the next 5 years in public-private partnerships to make these investments. So if it's on their radar, hopefully that will help enable the DOE, especially under maybe a more regulatorily lax administration, to get agreement in some way, shape, or form between local municipalities and companies and the federal government of how we actually do this. It's going to take time. There is not one single project that exists today, which is a huge problem, but everyone's talking about it, so hopefully we will see action going forward.
Yeah, and I call it the Jane Fonda effect, right? I think if you talk to baby boomers, generally speaking, and sorry for the broad generalization, that when I bring up nuclear, I usually see negativity on their face like immediately, like their body language shifts. They grew up in an era where nuclear was really considered to be extremely dangerous. And then when you talk to younger individuals, I find Gen Z, Gen Y, or millennials, I find that there's a real there's an openness to the technology that you don't necessarily see. And I think there's some generational things that are occurring. And I also think the public dialogue about nuclear has to improve. And it probably starts with our policymakers, with our politicians, who can start to have if we could just have a fruitful discussion about this, I think that would make a huge difference in terms of public sentiment, because some of this really does come down to just straight up public sentiment and what they're telling their local senators and their U.S. senators and Congress people. That ultimately has to change. Do you see an openness in other parts of the globe to nuclear that maybe are maybe a little more open to it than we are in the United States? And are you seeing enhancements with nuclear?
For sure. I think you look at, you'd mentioned Europe. They don't have any other options.
They don't.
I think they learned the hard way of their dependence on fossil fuels and not having a plan B. So they're starting to make investments there. But countries even like in India, for example, which has massive power needs, and the government actually mandating that at least 50% of power production has to come from cleaner sources going forward. And that number is going to keep increasing until it hits 100%, I think, 15, 20 years down the road. So they are actively starting to build plants. So you're starting to see even emerging markets look at this and say, rather than us building a coal plant today, why not make the investment in nuclear? There's less of regulatory hurdles that they need to clear in order to do that as well. So it's easier for them to put it in place. So, we can probably learn lessons from how things are done either well or not done well here in the US and implement as we start to build things out. But I totally agree. I think the dialogue, it's got to start from the top too. And It's got to be more than just a politician telling people, trust me, this is going to be good for you.
Right.
Just bringing in some of the hard data to show just how safe things are today, how the impact is much smaller than even a natural gas plant today. All of that I think is going to be important, and hopefully over time, through successful build outs, the proof will be in the pudding where Americans can see, this has been a big success. We want one in our state or our county.
Yeah, I actually interviewed a nuclear expert. His name is Andrzej Walker, and he's in Europe, and he's done a lot of consulting, and he's spoken to the English government, he's spoken to the EU, and he shared a really interesting story where he knows a nuclear expert, and I think she had helped with the way they were storing nuclear waste, and basically, I think it's in the Netherlands, and I'm trying to dust off the cobwebs on the story, but they would take the waste, and the biggest thing about the waste is it just needs to be behind pretty thick concrete walls. We don't necessarily need to bury it really deep. We just need it to be contained. The other thing he pointed out is that a lot of the actual contamination from nuclear waste comes from ingesting it. Yes, it can go airborne, but generally speaking, the biggest risk is ingesting it. So if you can keep it behind concrete walls, it's fine. And he said one of the nuclear scientists that worked at this plant, and I believe had helped design it, and then the waste facility, she was pregnant and she put her belly against the concrete wall with waste on the other side. And she said, it is so safe the way in which we dispose of the waste that I'm willing to put my unborn baby against the concrete wall. And so that's a powerful narrative. And I'd love to see more of that in the United States, that it's not as terrifying as the Chernobyl movie may portray it. Yes, that was a scary situation, but that's not the way it's going to run in the 21st century. And they're wildly safe in my estimation.
Yeah, 100% agree.
So let's go to a final megatrend. Something you've been talking about is the shift in demographics. And we've seen a huge population explosion over the last 100 years. Seems to be that things are trending in a different direction. What is your take on demographic trends from that sense? What do you think of the overall demographic move right now?
Yeah, so demographics are interesting because it definitely, it's a critical piece for economic growth as well. We talk about jobs too. So part of the challenge that countries like Japan and Europe have faced is that they've stagnated because they have a rapidly aging population. There's a lot more people retiring and dying than there are new people to come into the workforce. And that's a challenge. When you have like a ratio of retiring or dying out workers over 65 versus the younger ones, once that ratio goes below 1 where you're not growing, that becomes a problem from an economic perspective. Mm-hmm. It's long term, but it is a challenge. The US has always been blessed because we have had a reasonable birth rate, but we've also had immigration into the country, both high caliber workers, more entry level type of workers or hard skill workers. That has kept our ratio above 1%. So we've been able to grow. But like country like China, for example, that's been a rapid growth engine for global GDP. They are rapidly aging. They're going to be Japan down the road for a number of reasons. They save too much, also a problem in Europe, whereas Americans are great at spending money, as are people in some other emerging markets. So when you look at those statistics, there aren't too many countries around the world where you have a services-based economy where people spend money in the economy that's actually growing. You basically end up at this point, you've got the US, you've got India, you've got Brazil, and a handful of other countries. So like that automatically flags those to me as places that look really interesting for longer term investments. And I'll bring the demographic conversation in the US home too in terms of other really big, I'll call it problems, but also areas of opportunity that this demographic change is going to cause. One of them is in healthcare. We talk so much about healthcare, but we have an aging population. There's no way around it. And we as an aging population have more and more chronic diseases. We spend almost 20% of our GDP, $4.3 trillion on healthcare every single year. And that cost grows at 4 to 5% per year. So you want to find a growth market. It's not even necessarily AI. It's healthcare spending. So, when you look
powerful.
It's crazy when you think about how much money is there. And I would argue 25% of that 4.3 trillion is probably just abject waste of just communication between insurance company to hospital to doctor provider back and forth. There's no value add in any of that. So when you look at opportunities to bring down the cost without decreasing the level of care to a population that's going to increasingly rely on the system, there's a lot of innovation that can happen within healthcare and healthcare tech to help get rid of some of those costs. So I like to follow healthcare as almost a tangential theme to demographics because they're inextricably linked. And while there are problems in healthcare, that also means there's a tremendous amount of opportunities because we're going to have to find ways to do more with less, or at least the same type of pie going forward. And you do that through technology and innovation. And so there's a tremendous, I'll call it, ramp of investment potential in the healthcare space as a long-term investment trend.
Do you like medical device companies? Do you like fintech? Do you like a combination of the two?
It's a combination of the two. I'll say what I don't like. I don't like HMOs or insurance companies in that part of the market. They've been challenged for a while. Even big pharma, they are, besides your GLP-1 companies that had a decent run, those areas are under pressure from regulation and trying to bring down cost. I would argue that's the wrong place for us to look to bring down cost. Of that $4.3 trillion, we only spend a fraction of that, maybe like 20% or so, on pharmaceuticals. Pharma and drugs are not the cost problem. The cost problem sits at hospitals and sits at our providers. And so how do you make those more efficient? A lot of that comes through technology, like you alluded to. So technology, I think, can hugely improve what we do and the value add we deliver to Americans from the healthcare side of things. So that, I think, is a big area of investment, a lot of private dollars going there, but public dollars in the public markets, like you mentioned, Drew, it's medical device companies. How do I make a better mousetrap to solve some of these chronic diseases that we have? Call it diabetes, is one really, really good example. Constant blood glucose monitoring is one of those great innovations. How do you give better knee replacements? How do you make surgeries more efficient? Devices, robotics, all of that, I think, is an area of the healthcare market that has done well, but where we're seeing consistency of earnings growth. And so I think there's a good period for that to do well as we make more and more investments to provide better outcomes, but also bring down the cost.
And I said fintech, I meant more like medtech type stocks, but you clearly caught on that very quickly. Yeah, no, I completely agree with you. Let me ask you kind of a final question on the demographic piece, just stepping back again. Some people are suggesting that the demographic trends could lead to a major sort of global crisis in the future. Are you alarmed by that? And then I have a follow-up question for you.
I'm alarmed, but in a very long-term perspective. It's like the frog in boiling water analogy. It's going to take a long time for the water to boil, i.e. the age demographics, to really become the problem that sinks the economy. And again, the good thing is there's a lot of accelerators and offsets to that with AI.
I was just going to say that.
The ingenuity of I'd say the U.S. corporate sector that will help offset some of that. But 30, 50 years down the road, you can't get around that sort of demographic imbalance. But if we can figure out how to stave that off, which we have done in the past, we'll continue to be okay as long as that replacement rate remains above 1.
Yeah, and I really agree too that with AI we could see a huge replacement in terms of what was needed from just human beings that could fill in the gap in terms of our artificial intelligence. That gives me a lot of hope, which is yet another argument going back to the beginning of the discussion of why, hey, look, if you think your job's going to disappear, there's actually a lot of long-term trends suggesting that no, it might change, but there's going to be a lot of job opportunities in the future, which is exciting. I mean, there's some good among the negative. Any final thoughts as we wrap this interview up about the economy over the next 12 months? Anything that you would want investors to know over the say the end of the year and then over the next 12 months?
I think the biggest idea I like to come across, and I think we've done a good job during our discussion, Drew, on this, is just things aren't as bad as we might think they are based on what we read on a daily basis. I would actually argue things are pretty good, at least in what matters to the overall economy and to the growth of corporate America and the stock market itself. Earnings remain strong. Earnings season so far right now are near record highs. Corporate margins are still near record levels, even despite the initial impact of tariffs. We continue to see companies do well and produce more and do that more efficiently. So that all, I think, is very, very sustainable, at least over the next 12 months going forward. So there's a lot of reasons for optimism. And if anything, that pervasive level of pessimism that's out there, I think, is a good contrarian signal to the fact that the market can continue to do well. It doesn't mean that there aren't risks that are still out there. And I think that's why diversification, having balance in a portfolio, even balancing your AI investments like we talked about, that matters, I think, today more than it has in the past, because there are so many unknowns that are out there. But balance has worked incredibly well so far this year. And I think we're getting back to a normal, dare I say, market environment, maybe like we had 15 years ago before zero interest rate policy, where a lot of different things can do well just because the fundamentals are propelling them. So I remain optimistic, conscious of risks, but despite them, I think there's a lot of reasons to be optimistic.
I fully agree with you. It's really refreshing to get that type of perspective today. Matt, thank you so much for coming on the podcast.
It's great. I really enjoyed the conversation.
Me too. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.